Morning, my name is Bianca Haywood and I will be taking you through Disney's results presentation. Let's take a look at what we will be covering today. I'm going to start off with the nature of business, followed by the recommendation, the financial review, divisional overview, company guidance, and conclude with the portfolio guidance. Now taking a look at the nature of business. Disney is an entertainment company that conducts and operates in media networks, studio entertainment, theme parks and resorts, consumer products, and interactive media. The company produces motion pictures, television programs, and musical recordings, as well as books and magazines. Now moving on to the recommendation. We feel that the share holds value on an absolute basis. However, our view is dependent on limited content misses and the sustainability of subscriber trends. On a relative basis, the share seems fairly valued, trading at a forward PE multiple in line with its long-term average and trading at a premium to its large-cap media competitors. Determining a sustainable growth rate is complicated, given the evolving nature of the media sector with concerns regarding the sustainability of the cable network operations with cord-cutting and TV advertising softness, which raises the question if the industry is in a secular decline. The emergence of OTT technology and the evolving bandwidth efficiency of network providers have created a platform for a new era of video service delivery that decouples the service provider from the network provider. The continued strength of parks and resorts and a solid movie pipeline for the year ahead should support short-term earnings. However, income from theatrical business is variable and the profitability remains dependent on the effective monetization of strong portfolio of brands. Now moving over to the financial review. Revenue declined by 1% to 55.2 billion. Adjusted EBITDA was roughly in line with 2016 at 16.5 billion, which combined with an 11% increase in the depreciation expense resulted in a 2% decline in adjusted operating profit. The adjusted operating margin contracted 20 basis points to 25.2%. Profit before tax declined by 3%, mainly due to a 48% increase in the net finance expense due to higher average debt balances and interest rates. Profit after tax rose 3% to 9.1 billion, supported by a lower effective tax rate due to a lower rate of foreign earnings. Ultimately, airline earnings came in 4% lower, impacted by a 65% drop in profits from associates due to higher losses at BAMTech and Hulu. Diluted headline earnings per share was slightly lower at 570 cents per share compared to 572 cents per share, supported by a 4% decline in the weighted average number of shares in issue. That was mainly due to the group's share repurchase program. The full-year dividend declared amounted to 156 cents per share, representing a 10% increase. Now taking a look at the divisions. Media network consists of broadcast, cable, radio, publishing, and digital businesses. The division contributed 43% to group revenue and 47% to operating profit, making it the group's largest division. Revenue declined by 1% to 23.5 billion, while operating profit fell by 11% to 6.9 billion due to contractual rate increases for sports programming, lower advertising revenue, and higher losses from equity accounted investments in BAMTech and Hulu, which was partly offset by higher affiliate revenue. Growth in affiliate revenue was driven by rate increases, which was partly offset by a decline in subscriber base. The operating margin contracted to 29.4%, down from the 32.7% in the previous year. The group concluded the renewal of the distribution agreement with Altice. By the end of 2019, the group expects new agreements in place to be covering 50% of the group's subscriber base. Cable networks contributed 78% to media network operating profit, and in the fourth quarter, profits was impacted by a decrease at Freeform, which was partly offset by growth at Disney Channels due to higher program sales. At ESPN, growth in affiliate revenue was offset by higher programming costs and lower advertising revenue. Higher spending on programming was driven by contractual rate increases for NFL, college sports, and Major League Baseball. Broadcasting contributed 17% to media network operating profits. In the fourth quarter, double-digit growth in affiliate revenue and lower programming expenses was more than offset by lower advertising revenue due to lower political advertising, the absence of the Emmy Awards show, and general weakness at ABC. Program sales was impacted by fewer significant titles. Equity income contributed 5% to Media Network operating profit. Operating profit fell by 42% to 344 million due to higher losses at BAMTech and Hulu and lower income from A&E television networks. Now moving on to parks and resorts. The company designs and develops new theme parks, concepts, and attractions. This division contributed 33% to group revenue and 25% to operating profit. Revenue increased by 8% to 18.4 billion, while operating profit grew by 14% to 3.8 billion, resulting in an improved operating margin of 20.5%, up from 19.4% in the previous year. Both international and domestic operations recorded growth. However, in the fourth quarter, local operations was impacted by Hurricane Irma, which was offset by growth at Disney Cruise Line, Disneyland Resort, and Disney Vacation Club. Hurricane Irma disrupted the group's Florida operations and resulted in the closure of Disney World parks for 2 days, the cancellation of 3 Disney Cruise Line itineraries, and the shortening of 2 others. Attendance at the domestic parks improved by 2% as guests responded favorably to new attractions. Growth in international operations was mainly led by growth at Disneyland Paris and Shanghai Disney Resorts. Disneyland Paris benefited from the resort's 25th anniversary celebration and a more favorable tourism environment, which led to higher attendance, guest spending, and hotel occupancies. Higher guest spending was on the back of higher average ticket prices. Now taking a look at Studio Entertainment. Studio Entertainment produces and acquires live action and animated motion pictures, direct-to-video content, musical recordings, and live stage plays. It also develops and publishes games, books, magazines, and comic books. The division contributed 15% to the group's revenue and 16% to operating profit. Revenue declined by 11% to 8.4 billion, while operating profit fell by 13% to 2.4 billion, resulting in a lower operating margin of 29.4%, down from the 32.7% in the previous year. In the fourth quarter, the segment was impacted by higher film impairment costs due to the cancellation of the animated film Gigantic, lower operating income from TV distribution, driven by the sale of Star Wars classic titles in the fourth quarter of the last year, and lower revenue share from consumer products. Now taking a look at consumer products and interactive media. This division contributed 9% to group revenue and 12% to operating profit. Revenue declined by 13% to 4.8 billion, while operating profit declined by 11% to 1.7 billion, mainly due to a decrease at the merchandise licensing business. The operating margin improved to 36.1%, up from 35.5% in the previous year. In the fourth quarter, the merchandise licensing business was impacted by lower earned licensing revenues, higher third-party royalty expense, and an unfavorable foreign exchange rate movement. Strong sales from Spider-Man's and Cars merchandise in the fourth quarter was more than offset by strong sales of Star Wars, Frozen, Finding Dory in the fourth quarter of last year. Now taking a look at the company prospects. The group expects 2018 earnings to be suppressed by a couple of factors, including the consolidation of BAMTech and other investments in the direct-to-consumer service, which will adversely impact cable operating income by 130 million. Cable expenses is expected to increase high single digits due to the consolidation of BAMTech. However, excluding the impact of BAMTech, cable expenses is expected to increase low single digits. Management further expects the share of losses from equity accounted investments in Hulu to increase by more than 100 million in 2018 due to Hulu's investment in MVPD service and higher content spending. In 2018, capex is expected to increase by more than 1 billion. The group has commissioned 3 new cruise ships, which will be completed between 2021 and 2023. Toy Story lands in Shanghai and Orlando is nearing completion, and the construction of Star Wars lands in Disneyland and Walt Disney World is underway. The group started with their direct-to-consumer initiatives, which management believe is vital to the future of the group's media business. The BAMTech acquisition enables the group to launch robust direct-to-consumer offerings and the tool to stream video at scale. The group's first direct-to-consumer product will be its ESPN-branded sports service named ESPN Plus, which will be accessible through the new ESPN app and which will allow the users to access sports scores and highlights. The group will also leverage BAMTech to launch a Disney-branded direct-to-consumer service in the second half of 2019, streaming the latest Disney, Pixar, Marvel, and Star Wars movies in the first pay window. The group will also produce 4 to 5 films a year exclusively for this service. The service will also offer thousands of hours of Disney film and TV library product. In 2017, the group repurchased 89.5 million shares at a combined value of $9.4 billion and plans to repurchase $6 billion in stock in 2018, which is in line with what the group has repurchased over the past 5 years. The group will release 4 new Marvel, 2 Star Wars, and 2 Pixar titles in 2018. Now moving on to the portfolio guidance. We feel that the share offers value at current levels based on our evaluation together with the strong cash generation and a solid balance sheet. We would recommend a portfolio exposure of up to 5.03%. Please take note of the following disclaimer before I conclude my webinar. Should you wish to place a trade, please contact our trading desk. Should you wish to ask questions, please type them into the chat box and I will be getting back to you via email correspondence. That concludes my webinar. Thank you and enjoy the rest of your day.